Ladies and gentlemen, welcome to a new episode of the FinTech Hunting Podcast. We have an absolutely incredible guest for you today. She's a credit expert, host of Sue Knows the Score, a social media influencer, a published author, a credit coach, and more importantly than anything, just an amazing human being. Please help me welcome back to the show, Sue Buswell. Sue, welcome back.
Hey, Michael, thank you so much. And it's such an honor to be with you. I had so much fun meeting you in person at Housing Wire in Scottsdale. So this is a real treat for me to be on your show again today. Thank you for having me.
Oh, well, thank you for giving up of your time and your knowledge and your insights in it. It was delightful meeting you in person. For all of you who listen and see all of the incredible stuff Sue does online, she's even more amazing in person. So I'm so lucky that you're here with us today. So let's dive in. There's so many things going on with credit, and I love the combination of credit and technology. And so I'm going to just start throwing questions and let you share your wealth of knowledge and expertise. But let's talk about, I've seen a number of your recent posts. Let's talk about credit cascading and what is it? How does it work? Why should lenders be doing it in today's market environment?
Yeah, so Credit Cascade has been around for a long time, and there's a lot of different options depending on your provider, Michael. The number one benefit, I think, of Credit Cascade that comes to people's mind is cost savings because it saves you from going all the way to that expensive three bureau, right? But time is money, and people forget that when we use technology to help us do our business better, we're saving a lot more than the hard cost of a credit report. We're saving our users time. And that's what these cascades can truly bring if you implement them correctly.
I love it. So let's start kind of walking through how do they work, and then we'll get to how to implement them correctly. You said there's a lot of different options out there for our listeners who might not be very familiar with it. Let's kind of walk them step by step.
Yeah, absolutely. So a credit cascade in its very simplest form is often score based, meaning if your first credit score is below whatever the number is, I'm going to use 620. I use that in my post about this
Okay.
because I was talking with a lender and they said, if you can get my loan officers to sign on to this idea cascade, I'm fine with you. The reason we were having the conversation is their credit report bills were too high. And when I looked at what was happening, I said, I have a solution for you. So 620 was the minimum score. Anything below 620 had to go to their broker channel. And I'm working with a loan officer and I said, okay, let's look at your last 5 credit pulls. How often was your mid score below 620? And he goes, oh, no, the last 5 wouldn't work because they were all below 620. And I'm like, ding, 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 right? Winner, right? This is exactly what we want to do. And I said, so let's look at those. And we pull up those 5 reports. And sure enough, the first score was a 610. The second score was a 613. And I said, and then, just go through them, the same scenario. And I said, so on these 5 reports where you spent $50 each, you could have stopped at a $25 bill. That would have been your bill. That's it, $25. Let's turn this on and let's make sure that you're not buying that third, and most expensive bureau and the existing score and all those other things. No, he says, I have to have all 3. So there is a hard road to go from a credit provider to explain the benefit of this. But if you stick with it, you can get the mortgage lenders to understand it's not about denying applicants who can qualify. It's about ensuring that your team is spending your valuable resources on those applications that can go through. You need a process to off-ramp those that can't go through. Refer those to the broker channel. And I worked with a company who had a very robust Cascade system. It was Cascade plus workflow. And it had the ability to provide custom messaging on a report to give guidance. So there are a number of different cascades out there. And if you just go with the very simple, and for 5 credit reports for all of your loan officers, you can save the difference between 25 and 50. Wouldn't you want to have a 50% credit savings on credit applicants that don't qualify? Who wouldn't?
Well, and I think it's getting them to change that mindset, right? The market's still tough conditions. They don't
Right.
have as many loans as they want. So in some ways, it's almost that desperate mentality of, I've got to try everything. But to your point, if you can realign your mindset and say, I'm wasting time and effort on people that are not going to qualify through our channel.
That's exactly right.
Instead of doing that, let me save the time, let me save the money, the resources, and let me now focus and give better service to the ones that can.
Well, and let's talk about that because it's not that I'm saying just don't bother with those applicants because your pipeline has to continue to grow. So when I say offboard, maybe you offboard it to a broker, maybe you offboard it to an internal credit team, or maybe you offboard it to an LOA, a loan officer assistant, who can then take that one or two bureau, start talking with that borrower about possibilities to increase their credit, right? You don't have to have a three bureau to have that conversation. So off ramp that to someone who's going to be able to determine whether or not that consumer has the wherewithal and the means to resolve any credit issues to get their score higher. That's just one more value add that you can have. And you can do that with technology. You can do that with these cascades.
See, I absolutely love how you're not giving a one size fits all. You're actually giving people multiple strategies so that they can be more successful, more profitable. And at the end of the day, the borrower wins because they're getting the attention that they need so that they can eventually get the home that they're dying to get into.
That's right. Because and I think that's what Credit Cascade kind of got a bad rap at, really, Michael, is that, oh, you know what? I'm just not going to. But I can look at HMDA reports and I can tell how many applications you took. If you took an application, you ran a credit report. Then I can look at how many loans you closed and I can tell your success rate, right? And we all know it's on average 70% fallout. So if you're running a three bureau on 70% of your applications that are falling out, I know what your costs are. This is the type of work that I would have done, that I was doing with my customers. And I can tell you, when you get with a mortgage lender who is focused on better business and improving processes and building their pipeline of the future, a cascade is one of the best strategies that they could deploy today to do that. So as I said, there's multiple cascade options out there, but it's all about helping the customer realize it's not just about saying no or stopping it and saving those pennies, which actually is dollars, sometimes tens of dollars, right, today. It's about building a process around nurturing your pipeline for the future.
And I love how you talk about the pipeline of the future. So you're, like you said, you're not just saying no, you're giving alternatives. Talk to me, for our listeners that are maybe a little bit more credit savvy. Talk to me a little bit. I love how you broke down the numbers and said, well, I can look at HMDA reports. I know about 70% didn't go through. I know how much money you just left on the table there. What are some of the other cascade models for some of those more advanced users, or how are they leveraging different modes of technology?
Yeah, so there's some really fun things out there. I think there's some very basic cascades for customers who are on the Meridian Link platform. I think that there are basic cascades on other platforms. You have a limited number of providers who own and operate their own platforms, and they've been able to customize what they're doing. So that would be your factual datas, your IRs, informative research, Zactus, CoreLogic. I don't believe Equifax has gotten into the Cascade space, so I can't speak to what they're doing. But I know that when you take a basic credit report, and we all know that scores are not the only reason that someone doesn't credit qualify. So I had the privilege of working with a VP of underwriting at a very large nationwide lender, and we got into the reason why the credit reports were bouncing. Right? So the loans are going from, here's the loan officer took it and you got your credit report and it all looks good and you go to send it to processing and processing sends it to underwriting and underwriting sends it back and it goes back to, that's credit report bouncing or whatever you want to call it. Too many touches. That's the easy way to describe it. Time wasters is the way we described it. So we spent a number of weeks working on custom messaging that would help her team identify credit attributes, because some of these systems can actually get into, and one of my favorite ones to use was 2 times 30 in the last 60 days is a no-go for a GSE loan. Okay, so if you're 2 times 30 on a loan, on a mortgage transaction in the last 12 months, you're not going anywhere. Why would you buy a tri-merge? That's going to be on the first file. Why would you buy a tri-merge, right? Now, could you flip that loan somewhere else? It's going to be difficult. Right? It's going to be difficult to do that. So that was some of the really in-depth messaging that was available. But then you go beyond that and you start looking at things like there's an auto loan on the credit report, verify if it's a lease and how many months left to pay. That could be made into a custom message on the credit report. So what you were doing is creating a credit report that wasn't just 3 scores. It was an actionable report that helped every person who touched it. And the really cool thing was Encompass got to the point where you could start to pull that messaging in and put it out there like on a process or checklist. So there are some very sophisticated systems out there, and I think that they get less than 50% of their customers up and running on these systems.
Well, and why do you think that is? Why do you think there's such low user adoption for using those systems? Because the way you're describing it to me comes across as almost like a no-brainer. Why wouldn't you
Why wouldn't you?
incorporate these models? Not only are you saving money, like you said, you're building your pipeline of the future, you're delivering a better experience, and you're truly tuning into that specific borrower instead of just generic, here's how we treat all borrowers, just as like another number.
Yeah. I think it's because we are so afraid of change, number one. And who's the first person that touches the credit report? You train these guys all day long, Michael.
Yep, yeah, it's that LO. They're there. They're the one talking to the borrower, and they're the first ones who's going to interact with that.
Yeah. So changing the mind of a loan officer and building a process that will stop them from seeing all 3 scores is the biggest hurdle. But once you can get your underwriter online and you get your processing team online, this is a product you have to sell backwards, right? You don't sell it to the loan officer because they're not going to. So you have to sell it to operations, and you really have to sell it to underwriting because they're the ones that constantly have that ping pong back and forth when there's credit issues. And they're the ones that are working hard to solve those. So if you can present a credit report to a loan officer that's directional, that's informational, simple thing that we did when credit freezes were huge is put a notification on the report that said, notice, credit freeze found, and listed the 3 phone numbers for the bureaus, because in the early days of credit freezes, you had a call to get it removed.
Right.
Directional, actionable reports, but you really have to sell it to the underwriters who will turn around and sell it to the loan officers. That's why it's so hard, because obviously most mortgage lenders are their sales team, their top producing loan officers, they've got to sign on to these types of significant changes. When they do, it's magic.
Well, I love that because you talk about actionable insights. And when you share information, Sue, you have a wonderful gift of making complex issues become very simple, very understandable. And I think to your point, if you can sell to the underwriters and if you can sell to the operations teams, here is the lift you're going to get, and then take it down to here's the benefit for the loan officer. We're giving you actionable insights. Here's how you can counsel the borrower. Here's how you're going to get the transaction through. It's a win-win across the board. We all have to look at how to get more profitable loans, right? I mean,
absolutely.
It's terrible in our industry when reports come out and saying, now we're only losing $600 a loan instead of $1,200 a loan.
And everyone's like, yay, we're still losing money. I'm like, wait, why are we celebrating? Let's stop losing money.
I couldn't agree more. Why are we complimenting people for losing money? It's just right. They lost less.
Right.
So this is a perfect example of how you can start reducing the cost to originate a loan in a very strategic and thoughtful way that benefits all parties to the transaction. The 100%. Underwriter, the loan officer, their op folks, and more importantly, the borrower. Sue, you have so much great knowledge and insights. For anyone, go follow Sue on LinkedIn. She's got incredible posts every day. She's giving great insights. One of the other topics I want to bring up, I've seen you post about this recently, is buy now, pay later.
Oh, yeah.
Talk to me about buy now, pay later, the different apps that are out there, the impact it has on credit.
Yeah. So right now it doesn't really have an impact on credit, which is the risk for our industry, right? And I did a post on it, and what was some of the most gratifying comments and feedback I get from my post comes in direct messages or emails. So thank you for those that do that. But Since I did my first group of posts on Buy Now, Pay Later about 5 months ago, I circled back. I had a couple of lenders reach out and say, we now have a questionnaire that we're utilizing because they didn't understand, number one, that Buy Now, Pay Later is instituted or the loan is taken under with a soft pull. So no UDM, no LQI, there's no way you're going to know. So you don't know that there's a loan. It could be 4 months, right? Interest free, whatever. It could be up to 60 months. It could be up to $17,000. You don't know on a soft pull. There's one agency that's reporting, which is a firm, to Experian, but they are not, we have to remember that credit reporting, creditors reporting their data is voluntary. It is the
Right.
craziest thing to me about our system because we're not requiring our creditors to actually report the data. And there's no requirement for them to report the data, then there's less requirements for them to report it on time and report it accurately. And yeah, they're supposed to, but when you don't even require them to do it. So buy now, pay later is a huge risk. It is phantom debt for the mortgage industry. If the consumer gets a loan on a soft pull and it's supposed to be paid off in 4 payments, which is several weeks, you wouldn't even know it's there.
Right.
Because if they don't make a payment, you're not going to find it on a bank statement. You're not going to see it. If they don't make a payment, you don't know this debt is there. It is a huge risk. And the average buy now, pay later consumer has 4 loans at a time. 4 loans at a time. So they're not reported. There's no impact on your credit because we have to think about how buy now, pay later works. It's typically 4 months of payment. FICO requires us to have 6 months of open and active credit history for a trade line account. So a brand new account that has no current activity on it would only count as an inquiry, but it won't count as an inquiry because it's a soft inquiry. Until
Right.
they start making payments and they start reporting, there's no impact. Now, Vantage Score, when we adopt Vantage Score 2025, maybe, they would see the buy now, pay later. And I know that the bureaus are collecting this data, but it is just not significant enough yet. I do imagine, and I posted yesterday about the percentage of buy now, pay later consumers that are delinquent or have missed a payment. And it's like 18%. And over, I believe the statistic was 39% have indicated they spent too much. So you've got phantom debt that people are overspending on. And the saddest thing about it, Michael, is that a lot of people with today's economy are putting their necessary items on buy now, pay later. It's not,
Right.
oh, I like that purse and I don't want to spend $100 on it, so I'm going to put it on buy now, pay later and spend it over, four payments. So there's a lot of risk for mortgage, but to the consumers, there's a huge amount of risk.
So what can lenders do about that? What can originators do? Like you said, it's a blind spot that they have. Is there anything that they can do to at least start putting a light on it and drawing some attention to that?
I think having the questionnaire is brilliant. You need that in your file. If you somehow end up with a repurchase because the borrower's DTI has gone too high because this unreported debt is now reporting post-closing and the open date was during the loan processing time, you're typically going to get some sort of a question on that. So I think having that questionnaire in your file from a compliance perspective would be an absolute necessity. I know a lot of lenders rely on that. Do you have any other debts that are not on your credit report questionnaire? But I think this is one step to add to that. Are you using buy now, pay later? Have you taken out any loans since your application? Did you take out any loans 60 days before your application? Because they could be in a repayment or should be in a repayment and you don't know it.
Right. Great tips and suggestions, Sue. You always have such a wealth of knowledge and expertise, and they're very practical tips. All right, as we're winding down, and you and I will keep having more discussions,
Of
you are
course.
welcome back anytime. What are some of the other things that you see coming down the pike the rest of this year, early next year? What do lenders, what do loan officers need to be on the outlook from a credit perspective?
So I think one thing that we all have seen is that the credit box tightens, right? As interest rates and inventory were an issue. We're seeing a little bit of improvement with inventory, but everyone's saying, I don't know, stay alive till 25. I think that we have to make sure that every opportunity we have to engage with a consumer comes from an informed place as it relates to credit. Because yes, a lot of consumers are monitoring their credit, but they're not using the FICO 2, 4, and 5 that we're using today. So we still have to make sure that we're informing and empowering ourselves to help our customers achieve their best credit score, not the golden 800 or 850 that people aspire to, but the best score for that moment in their life, right? At where they're at, what they need to get into that home. And then make sure that you're focused on not just closing a loan, but creating a successful home buyer. Because as we talked about the pipeline of the future, the people that you successfully set up to be good home owners will be your next buyer and your referral partners. So that's just really key. I'll be on an FHFA call later today. We're going to get the Vantage Score 4.0 historical data will be released, and or access will be provided to it. So that initiative is moving forward. There's a lot about buy merge, tri merge, still the controversy of it, but I think that we are going to have change in our market, in the mortgage lending space, as it relates to scores and as it relates to credit file requirements. I think we're going to see big changes towards the end of this year. I think we'll continue to have conversations with FHFA about it. There's just a lot coming. And so the more that we can do, again, you can follow Sue Knows the Score for that. I put out a lot of information about Vantage Score 4.0. I am a fan of a new score model. The FICO 10T is fantastic. So a lot coming, and we can always have just a whole separate conversation on those things, Michael.
Absolutely. And one thing I want to wind down with is, Sue, I always tell people they've got to put themselves out there. They've got to add value, informational value.
Mhm.
You have done one of the best jobs that I have seen over the last year or two of putting yourself out there and truly adding value to our industry and the people. What would you give as advice or suggestions for people that are kind of on the fence of, well, I don't know what to say, I don't know how to get out there, because you are a role model of how to do it the right way?
Well, so I will say just do it. When we were at Housing Wire, I think it was Coach Bill Hart that said so many people say, one of our book co-authors, so many
Yep.
people say, I don't like the way I look on camera and I don't like the way I sound on camera. And the fact is, you look and sound the same way when I meet you in person as you do on camera. So first of all, just do it, be real, and speak about something you're passionate about. And that's what I've done. I just did it. I just decided that I had the privilege to gain this knowledge through my almost 40 years in this industry, and I needed to give back to this industry because of the privilege I had to gain this knowledge. So do it, make sure it's something you're passionate about, and then find your rhythm. For me, it's week-long posts covering the same topic and making sure that I fully explain it, and then we move on to something new. So just do it.
Well, you do a marvelous job of it. I can't thank you enough for being on this episode. If people want to get a hold of you, what's the best way they can get the credit tips, contact you? If they have other questions, what can they do to get a hold of you?
So they can reach out to me on LinkedIn would be great. I do have a website at sueknowsthescore.com. So you're more than and welcome to reach out there. I have an email address. It's a little long. I think I tried for the longest email address possible. So you can reach me through there. You can DM me on LinkedIn. LinkedIn is my space. I'm not social anywhere else, so don't look for that there. But credit is a part of what I do. I took on a new opportunity, so I'd love to share just a little bit with your team about what I'm doing there, if you don't mind, before we wrap up.
Absolutely. Please do.
So I'm working with a very good friend of mine, Brad Bogle, who started a new business called Gridivate. They are a data solutions provider, and in the coming months, we're going to have some new opportunities coming to the mortgage industry in the way of data solutions. So I think if anyone remembers some of the new technology that Brad brought to market through his time with Data Verify, you'll know that his goal is always to raise the bar. My goal is always to raise the bar. You know, my mom always used to say to me, "That's great, honey. What are you going to do next?" So I just have kind of built
Exactly.
that way. It's like, okay, there's no top, there's just more. So it's
Well,
been a
and
fun
Sue,
run.
we've already talked about in a couple of months when you guys are ready, you are welcome to come back on the show. We want to hear about it. Data is so critical, and I think to your point earlier, actionable data is much more important. It's not just collecting mounds and mounds of data, it's learning how to use it so it benefits all parties involved. Sue, I can't thank you enough. You share so many key insights. It is a privilege to have you on the show. Thank you for being a guest on this episode of the FinTech Hunting Podcast.
Thank you, Michael. Bye bye.